Okay, guys, so we've had a look at the leading economic indicators that help us get an idea as to whether the economy is going to be going through growth and inflation or contraction and deflation, and then how that's going to have an effect on the expectations for interest rates to be going higher or lower. And as we know, that has an impact on the currency, has an impact on the stock markets, as we saw in the previous video. So now what we need to look at, guys, is how are the markets really predicting a certain level of inflation? It's all good knowing that there's going to be some type of inflation, but obviously central banks, governments, professional investors need to understand a specific expected rate of inflation to know how likely it is that the central bank is going to be raising interest rates or lowering interest rates. For an example, so there's something called the break-even inflation rate. Now, the break-even inflation rates is how the markets measure in real time their expected rate of inflation over different time periods. So, for an example, what is the inflation expectation over the next 1 year, over the next 2 years, over the next 3 years, 4, 5 years, even up to the next 10 years? Markets will use a strategy, which I will show you, to create quite an accurate view on their expected rate of inflation. And these inflation expectations is what the markets are using all the time to price in the expectation of central bank policy decisions of interest rates or bond yields, which I want to talk about in great detail because it has a massive impact on the currency markets, the amount of interest payment government debt. And of course, when the markets start to buy currency or sell a currency, because what they're expecting the central bank to do based on this expectation. So what I'm going to do, guys, I will take you over to this spreadsheet, which is something that I use for my advanced course members. And this spreadsheet is amazing because what it's doing is giving us an expected rate of inflation in a country. And I will show you how we come to this expected inflation rate. So there's a thing called break-even inflation rate. So if you are aware of bonds, so if a government is receiving less tax revenue than it costs to run their economy, then they obviously have to borrow the difference from investors. So they raise money by selling bonds. An investor can buy a bond, for an example, certain amount of interest, and hopefully that interest rate is above a level of inflation, and an investor can keep the purchasing power of those dollars they've invested, or hopefully make a profit. And basically that's what pension funds, insurance companies, and investors that don't really like to speculate on currency moves or stocks or commodity prices, they like to buy bonds because they're quite a safe place to park your money. Because, for an example, if the US government borrows money to run their economy, they've never defaulted on their debt before, so the risk of the US government defaulting on their debt is very low. So investors love to buy government bonds because the government's always going to repay you back your principal and some interest, which makes it very attractive to investors. Now, what this is called is a bond, and then you have an inflation. You have TIPS, which are called inflation protected bonds, which basically this TIPS beta is basically giving a specific amount of interest based on the expected rate of inflation. So the two types of bonds, which I'm going to touch on in a second, but to get the expected rate of inflation, investors basically are minusing the TIPS inflation rate from the bond yield inflation rate, and then you get an expected rate of inflation. This is how the markets use expected inflation. So at the moment, as I shoot this video on the 24th of July, the markets are expecting inflation in the United States to be 2.5% over the next 5 years. Over the next 10 years, they're expected to be 2.33%. And as we know, we have the inflation target from the US Central Bank of 2%. Currently, it's quite above 2% at 5.4% and 4.5%. So this is very important, the expected rate of inflation. So what we do is, as course members, we look at the inflation rate every single month, or we update it to see, is inflation expectations going higher? Because if inflation expectations are going higher, then we know the markets can start to price in the expectation that the central bank, for an example, may start to raise interest rates, for an example, or, which I'm going to touch on in the next video, what's going to happen with the bond yield to the interest rate paid on government bonds, which is going to be affected by this expected rate of inflation, and what's actually happening in the economy now. Because investors are going to want to have a good amount of interest to protect them from inflation. So We look at break-even inflation rates. We can have this for all the countries. So we could look at the UK's inflation expectation over the next 5 years, which is 3.27%. We could look at Europe's inflation expectations over the next 5 years, for an example, which is 1.4%. So much lower inflation expected in Europe than in the UK, for an example. We could look at Canada's expected inflation of 1.97%. And then we can go to countries that are expecting higher levels of inflation. So like Mexico is expecting 4.42%, or South Africa is expecting inflation at 4.61%, for an example. So this is very, very important, because once we know about the expected rate of inflation, as I go through this spreadsheet and I show you how we use this data, it really does start to give us an idea of, okay, so the inflation is expected to be around this level over the next 5 years. And remember, this is what the professional market is using. So if you got a Bloomberg terminal, which I know probably a lot of you are not going to have, is very expensive, but this is the information which I get the inflation expectations from. So look, for an example, in the United States over the next 5 years, inflation is expected to be 2.5%. We could have a look at, for an example, what the inflation rate in South Africa is expected to be over the next 5 years, 4.4%, for an example. Or let's look at Brazil. What is Brazil's expected inflation over the next 5 years? 5.15%. Or we could look at Mexico. What is Mexico expecting for their inflation over the next 2 years? Could be 4.29%. So the market's basically telling you what they're expecting. Remember, this is how professional traders are getting their trade ideas. They're looking at the expected rate of inflation. They're looking at the central bank's target of inflation. And then they're looking and saying, okay, well, is inflation going over their target or below their target? And then what are the markets then expecting for interest rate changes, which is over here, which I'll touch on a bit later. But we then start to look at what the US central bank is expected to do over the next year. Are there any interest rate hikes expected? Right now, the United States, there's not, okay? But for other currencies, for an example, we can start to look at markets price. And then, for an example, New Zealand, they're expecting interest rate hikes over the next 6 months. In the next 3 months, they're expecting an interest rate hike. In the next year, they're expecting more hikes. So we could look at the New Zealand dollar and be like, well, we know interest rates are expected to go up in New Zealand. And as we know, that's going to attract money into New Zealand, especially for the differential in interest rates when we're taking positions in the currency markets, like I was touching on. And then we start to generate our trade ideas. So that, just remember, this is all fundamental driven first. Before I touch on technical analysis, before I touch on risk management strategy, before I touch on chart patterns, try to get into the markets, we first of all have to build out our fundamental foundation first to know what's going on, just like the professionals do. And then we look at how to get into our trades at the very, very end. Notice how I haven't gone over any technicals. I'm just teaching you the fundamentals first, because if you understand the fundamentals, you will start to trade like a professional. You'll start to make profits like a professional, and you'll start to be able to look after your income, your retirement, and really trade the correct way when we're trying to get into the markets to make money. So that's break-even inflation rates. We're using the Bloomberg terminal. We're getting the market's expectations for inflation for us to get an idea as to whether we're now, in the next video, I want to talk about bond yields. Are the bond yields going to be going higher, which is going to affect the currency markets? And then after that, what are we expecting for an example, interest rate changes? And then we start to look at oil prices. We start to look at other commodities that have a big impact on inflation. And then we start to really get professional trade ideas, guys. And then we look at technicals. Then we look at price action. Then we look at risk management, for an example. So guys, now we're going to move on to looking at bond yields. Thank you.